I saved up, and I was working McDonald's jobs. I was surveying field hand or cleaning cars. Like that was about a 6-year process to get the first deposit for that 2010 house. And I think it was about 60 odd thousand. And then I was out of money basically. So that property I'm back to saving from square one.
Welcome to Checks and Balances, brought to you by Partners Life. I'm Michael Vincent. This is James Blair. And today we've got Scott O'Neill, Group CEO of Rethink Group Australia, commercial property guru, here to talk about his story. We're back in your life. Scott, welcome to the podcast.
Thank you. Great to be here in NZ with you boys.
Yeah, no, I mean, a lot of respect to you. I was like, let's just do this as a Zoom call, and you're like, nah. I want to look into your eyes. I want to see. You really prefer doing these things face to face, do you?
Oh, look, I just wanted to get to New Zealand, to be honest, and you guys reached out. Great opportunity, and you know what it's like when you do these on Zoom. It's just not the same. Yeah. The conversation doesn't flow as well. So yeah, just wanted to catch up and do it properly.
Yeah. Cool. Only tip next time. Be like, let's organize this in Queenstown. Yeah. We'll meet you guys down there because definitely need to head down that way. So Scott is, we're going to talk all about Scott's background in the business he's built. It's all around that commercial property space, which safe to say in terms of checks and balances, we haven't done a lot in. So there's two ways to learn. There is talking about somebody's story or talking about the education side. So we're going to do a couple more podcasts with Scott. So make sure you subscribe to the channel so you can listen to those ones. But today is, hearing about how you got where you got to. And it's a pretty interesting story because, I mean, you've got, the largest commercial buyers agency in the country and over $100 million commercial property portfolio, but you weren't always a commercial property guy, were you?
No, look, I grew up just, in a, standard middle-class suburb in, south of Sydney, and I studied to become an engineer. So I was always good with maths, and I thought, let's get a job that goes outside. So civil engineering was the one that I landed on. Didn't want to be stuck behind the desk all the time. And I did the uni degree, and it was such a rude shock getting into it after those 4 years of uni, which I loved uni. And then you went into, a railway, staying on basalt, 12 hours a day, 6 days a week. And it was just hard work, long hours. We worked weekends. A lot of my mates were doing marketing degrees and business degrees. So they're all having like the best time ever in those early kind of career days. And I was just managing conduit, getting installed under train tracks. And it was a good job. It paid well relatively for a graduate, but I just knew I couldn't stick in that forever. And yeah, that's where property kind of started creeping into the background, just something else, what to do.
So you've got this job, you've gone, I want to do this forever. I want to do something different. The interesting thing, Mike and I do a lot of work with engineers and take the piss out of engineers. I'm surprised you got started with the first one because we talk to engineers all the time and they've got 1,000 spreadsheets. Their models are better than ours, but they are great sufferers of paralysis by analysis. But clearly you got over that and purchased your first property. Tell us about the first ever property you bought. Where was it? How much did it cost? How did you find the deposit to get going?
Yeah, look, you're so right. Like the risk is it's all about managing risk as an engineer. So we always had to kind of sign off on things, and you're always told we're going to jail if that happens, or if that person gets hurt, you're liable for that. So it's inbuilt into you. And I started looking around 2008, 2009. We all know what happened then. The old GFC was creeping through the markets, and I was always investing with the idea that the property may not grow for quite a while. So I sort of landed on, all right, I'm going to buy the cheapest possible house in a capital city that's freehold. Instead of buying a unit, because I was looking at units at the time, they were much nicer, more bang for buck. But obviously I was thinking, oh, look, you could build more of those. And, if you got the land, it's going to be okay in the long run. Yeah. So I landed on a house in granny flat in a suburb called Sutherland, which is about 45 minutes drive south of the CBD in Sydney. And why I liked it, it had a granny flat and a house. It was an older house, but it was pushing out about $660 a week, and purchase price was $480. Yeah. Which is really good yields back then. Like normally you're getting, you pay $500 and you get $400, $450 rent. Yeah. So the granny flat made the cash flow difference. And then that just made me think, all right, well, if it doesn't grow, I'm still covering my bases. And it did take a lot of the risk out of it.
Yeah. And then in terms of, I guess, going from one residential property to a few residential properties, talk to me about that story. Did you think, I like the idea of this, or actually there's not much risk here and there's some potential for capital gains, or what were you thinking?
Yeah, so there was a fair while in between drinks between first property and second, like there always is, because I saved up, and I was working McDonald's jobs, I was surveying field hand or cleaning cars. Like that was about a 6-year process to get the first deposit for that 2010 house. And I think it was about 60 odd thousand, and then I was out of money basically. So that property I'm back to saving from square one.
Yeah.
Then I did renovate that one a bit, like sanded floors, put new kitchens in, stuff like that. And basically in 2 years, even though it was a very flat market in 2010 and 2011, there was just enough equity to kind of half fund the next deposit. And this is where I just sort of went off track and went back to owner occupier. Because I was a rent investor. I was like, well, I'll just rent for a long time. And saw this house in Maroubra, which is closer to where my wife lived at the time, and made sense. Got into it.
Lovely spot.
But it had the strata. It had this is probably one of the poorer investment decisions I made. And and then I bought that. That was about I can't even remember, mid 600s for that price.
Yeah.
And then after that, it was another 2 year or year and a half before I was able to buy it. But I moved for the engineering job into Port Macquarie, so that was regional Australia. One of the best things I ever did, because it opened my eyes to not get out of the Sydney bubble.
Yeah.
So this is quite early. Everyone was still investing in their own backyard, and I all of a sudden had a bit of a Australia-wide focus, because I could have been working anywhere with my job. Every 2 years, the projects tend to change.
Yep.
And basically, I bought a unit block, and that was 2014. So that's 4 years after the first one, and that was the game changer, because that was 425 grand. And it was renting for $880 odd a week, because there's 4 units, 1 title.
Yep.
That's the positively geared game changer.
Yeah. And that's really kind of what some of our customers are starting to look at, as well as actually in the residential space. The cash flows are looking pretty average at this point. And, a lot of people are starting with those multi-units and obviously kind of ending up on the commercial side of things as well. So you got about 14 residential properties in one hit, was it? Or
yeah, so it started moving much quicker up there. Like I was getting paid more as well, which was big tip for anyone. If you want to build your portfolio, just chase those jobs that pay you an extra 20 grand a year. Like if you got to travel, like I was just upping the salary every time I did that, more lending capacity. So didn't have to start businesses, didn't have to like pull rabbits out of the hat. I just was getting paid more naturally through career progression. So portfolio grew with the career, and then the strata tiling idea came out. So this is what kind of really got me to that 14. I was buying pretty worn down unit blocks. This is at a time when they weren't really focused on. Nowadays, like everyone's all over them. So like the yields are much tighter, and you've got to basically, I was buying, let's say there's 5 units on one title, they might be worth $1 million, but separately they might be worth 250 each. So they might be, 1.25 mil, so there was upside in the numbers through strata tiling that would clean up a new deposit for the next deal. The yield was sort of maintained each time. So serviceability was good, but I still ran out of serviceability. And that's where after the 14 back in, this is like end of 2015. So 5 years later, started looking into the commercial space.
And when you had that residential portfolio, loose numbers, what was the value of it? What cash flow wise, was it giving you any money? Were you topping it up? What did it look like? Yeah,
so look, interest rates were a little bit lower back then, but I was like, it was circa kind of 10 mil type territory. And, I was getting 6-7% gross yields each time. And so net yield. So it was, I would have been about 50K ahead after all expenses. So, not shooting the lights out, but enough to kind of, get by. And obviously it was all about pushing the rents up when you could, hoping the property's value would go up. And like the asset base at 10 mil at that age, I was still quite young, early 20s. It was a good asset base that I knew in 10 years that 10 might be worth 16 mil, and that's where the good stuff happens.
And that's an incredible achievement, having that size portfolio. Did you have how did it happen over time? Was it just you bought one and then you were like, I want to be able to get the next one when I did? Were you financial literacy, like growing up? Did you have a mentor? How did it happen?
Well, look, two things. I got exposed to investing very early. So my dad helped us buy some Telstra shares when I was like 12, 13, like really young. And I'd noticed the dividends coming in. Like it was $12 to dividends. So nothing, because I was only investing a small amount. But it gave me the idea from a very young age, like you can put money somewhere and then it expands, like $1 turns into two, that, basic kind of analogy. And that just meant I never thought money should be in a bank because you can do better with it. So, and there's different levels of risk. So, I always watched the stock market rather, and always enjoyed it. Like I remember year 10, we had an assignment where it was like a hypothetical. If you had 100 grand to invest, and it was like a competition who to invest, that, and like I came one of the top in the year because like I was buying things like Qantas shares and like, a couple of specky type things. And I just really enjoyed watching what the companies were doing. But the real kind of, to answer your question, how it all worked is I just obsessed over property. Like there was no shortcut. I would, every chance I could at work, I'd be sitting on those spreadsheets, those engineer ones. I had every property that I looked at in a table, rating them from yield to risk to, age profile, like pros and cons, like, and I'd quantify.
There's the engineer.
Yeah, it is. Yeah. It was always coming.
Yeah, exactly. But like, that's what you got to do. Like, there was no one that was going to do it for me. It was just like, how do I kind of weigh up all these opportunities and just looking at them nonstop? And I was letterbox dropping. Like I had this great job where I literally was managing sand mines and concrete plants all the way from Port Macquarie to like, over a 500 kilometre stretch, basically up the north coast of New South Wales. And it just meant I could sort of see unit blocks. Like that's what I was targeting at the time, pre-commercial. And yeah, like I was just saying, look, I'll buy this off market for above market rate. That was my letter.
Yeah. Call me. Yeah.
And I didn't really get any calls.
Yeah.
That was the worst bit. But because there was not enough good stock online. And that's what I was starting to realize. The resi unit block strategy was dead. This is kind of now getting into the 2016 era. And basically what happened, they all went up really quick in value, but the rents didn't. So the yields were not as good. And the opportunity was, 2 years ago, basically. So commercial, looked at a random shop in Port Macquarie, and the yields were like 9% net, which in today's terms is amazing because that would be probably a 5-6% net for the same deal. So that's where I was like, all right, the numbers work again. The spreadsheets look beautiful at that point.
All about the spreadsheet.
My eyes lit up.
Let's go through that. I guess that scenario where you kind of looked at the shop. Like, was there you just running the numbers in your spreadsheet, going, this is getting tighter. This isn't making as much sense. But then what was the thing that, did you always kind of have some interest and start to educate yourself on commercial property? Because in the webinar that we did last night, we talked about the biggest obstacle is understanding, right? Yep. Residential is so easy to understand. How did you just stumble across that shop, or how did it all start?
Well, I was quite experienced in residential at that point, and what interested me was the cash flow. Like I didn't look at the shop and go, I'd love to own that. Look, to be honest with you, it actually had resi on it. So it was residential up top and then the shops down the bottom. So I was like,
you got catfished.
Yeah, exactly. So it was kind of like I got moved into it accidentally. And then I thought, well, why do I want the residential at the top? And so I then started looking at pure commercial, and the numbers got even better. As you know, finance can be a bit tricky for those mixed use types as well. So I found that out. And then basically, commercial, it was the numbers. To be honest with you, it wasn't the types of properties. Nowadays, I kind of get more excited over certain deals because I kind of understand the growth rates of different asset classes, how secure some investments are versus others. But back then, it was just a cash flow equation.
Yeah. Okay. And then so kind of you've taken the commercial property pill, so to speak. You've gone in that direction. How did it? Have you like retained all your residential portfolio? Did you end up selling off some assets? What happened?
Yeah, good question. I got to about, like I actually looked this up a little ago. So I've purchased about 40 odd properties and I've kept 29 of them. So I did buy a lot and sell a lot of residentials. I plan to sell I think I've currently got somewhere about 12, 13, 14, something like that, but it did get it much higher. But yeah, the reality is I will sell them down because they don't solve any problems for us now. They just create problems because of the maintenance. They're growing in Australia as well, and there is a time where it's going to peak. So I want to kind of sell off just before whenever I believe that peak is, and it's not far because there's a lot of change and regulation happening in Australia that it's getting more restrictive. But residential, and I always say, you need residential in your portfolio. I've never really met someone who has 100% commercial. I've met a lot of people with 100% residential, but the best investors have a bit of both. You start with residential, let you build your equity up. It's low risk. You can kind of find your feet on it, and then you move into commercial, and that's where you kind of actually retire.
Yeah. And then we've got the residential portfolio. You're starting to look into the commercial stuff. How many did you kind of purchase before you thought, I'm going to make this my business and I really want to have a crack at this?
Yeah, it was as soon as I started looking at it, I kind of knew I was onto something other people needed to know, because I looked for about a year before buying, and the only information I could find was stuff out of the US. There was no podcast, there were no Australian books I could find. There was zero information. So I was kind of like just relying on like local agents on the ground for information. And as you know, they represent the vendor. So they're telling me what I want to hear about their specific deal.
But not necessarily 100% of what I need to hear.
Yeah. Or if you talk to a competitor agent about a competitor's listing, they just do the opposite and say it's terrible.
Oh, it's trash,
like,
man.
it's just
You'd be an idiot to buy that.
Yeah. There was just no advice that was, really looking after me. So it was just manual. And like I asked my parents at the time, because I was still younger, what do you think? And they're like, don't buy it. You're an idiot. I asked locals in Perth, because that's where I bought. They're like, nah, Perth's crashing. Don't touch it. You're an idiot. Like I literally got told by about 10 people, do not touch this deal because it's going to fail. And, as we mentioned last night, it was just a little supermarket, 400 square meters, and a fish and chip shop, about 150 square meters. And there was 2 deals. Both businesses have been operating for multiple decades. The fish and chip shop was around for 35 years. So, a lot's gone down in 35 years in Perth in that period, yet it still survives. So I was like, this is a safe bet. Everyone doesn't know what they're doing. Yeah. And everyone I asked had no commercial experience as well. Yeah. And that's the other thing.
Everyone's got an opinion, but where is this coming from?
And where do you find a commercial investor to give you advice? Because back then, 10 years ago, the only investors, there weren't many. They were mostly just owner-occupiers, like guys or girls owning a big shed where their business was running out of. And they're just doing it for different reasons. Yeah. So, and then the other investors were fund managers, and,
they're not going to talk to you.
Exactly. Yeah. Different ball game. Yeah. Different price point. So.
And when you're buying that transaction, because we always talk about this, right? It's the same as, buy low, sell high, but it's very difficult to actually get people to buy at the bottom of the market. Yeah. You've got everyone you're asking you saying, don't do this.
Yeah.
You're an idiot. You don't know what you're doing. What's the thing that gets you over the line? Is it just looking at the numbers, or do you have something else where you're like, you know what, stuff it, I'm going to go do it?
Well, now I'm trained to actually see that as an opportunity. Like this is the old Warren Buffett saying, be fearful when others are greedy, and greedy when others are fearful. And it's really hard to do that in practice. And that's by my first property. It was just after the GFC. I was literally reading article after article on mainstream media saying there's a 40% crash happening.
Yeah.
All of them were saying the same thing. And then you go onto chat forums, and I was obsessed with chat forums back then, because that was information, and all these nobodies are just massively opinionated on exactly where the direction of the market's going. So no one was really going heavy in 2010, but if we had a crystal ball and knew what would happen, you just load up on everything you could back then, much debt as possible, and you would have made a lot of money.
All obvious in hindsight, right?
Yeah. And that's sort of why I'm in New Zealand now with, helping New Zealanders with commercial property, because I see this as an opportunity. Your interest rates, you had 5.25% interest rate rises in total. That's massive. And then the market's kind of tanked a bit in certain areas. Yields have now got better, and now you're on a downward cycle with interest rates. And a lot of Australians are actually looking at New Zealand too. And the first thing they do is scoff at the interest rate because it's still a little bit too high.
Yeah.
So they're all going to wait. They're going to wait for the interest rate to be perfect. That's what the masses will do. It's the worst thing. You got to get in while there's a bit of pain. Don't get in after it's perfect, because as soon as it's perfect, every vendor's going to want more money because they know they can get it. You're up against 10 times the buyers. But yeah, human psychology is very powerful. You can't switch it.
It's like the resi market, at the peak of, end of 2021, where, we're talking to people and they just there was that FOMO, everybody wanted another property or that kind of thing. And you're like, well, interest rates are like 2%. Have you run the numbers to make sure like this is all good? And they're like, just give me the thing. Like,
they're looking at us like we're idiots. And we're like, are you sure you want to do this?
And to kind of back that up as well, like I was getting asked by New Zealanders because our business model helping commercial investors isn't in New Zealand. And 2021, I was getting quite regularly New Zealanders wanting to help in New Zealand. So I looked at it. I looked at your interest rate and I looked at the yields on offer, and the yields were just terrible because everyone was paying too much. So basically, the more you pay, the more the yield looks lower and lower. So it just didn't make any financial sense. And I'm very happy we didn't get in at that time because, we would have suffered 20, 30% falls.
Before we move on, we talk all the time about planning and growing our wealth, but protecting that wealth is just as important. That's why having the right insurance in place can help when life goes unexpectedly.
And that's why this episode is brought to you by Partners Life, a New Zealand operated award-winning insurance provider with over 300,000 Kiwis insured and 89% of claims paid.
Partners Life understand that having some insurance is better than having no insurance. They have flexible and personalized solutions for any budget or situation.
Check out their website in our show notes below.
So I want to jump back to the birth of Rethink. So you're going. I can't find much information. You've bought this fish and chip shop. You're kind of now starting to look at commercial property. Are you still an engineer at this point?
Yeah. So I was starting to plan the exit at that point because we had about 150 grand passive income at the time. So my first goal was replace my wife's income.
Yeah.
So we did that. And the next one was just replace half of my income, and then the idea was to have a break, and we did. I went to Europe for 6 months, best time of my life. But I remember it was end of October, and the summer was ending in Greece, and everyone was going home back to work, and I'm just sort of this random Australian
nomad just sitting on the beach,
watching them pack up all the cafes for the winter, and go, oh, what now? So we went up to Germany for a bit, and then I was just and then it got I was like, I can't be doing this. I've just had no purpose. And then I was in a random, my mortgage broker actually got us into one of those old magazines in Australia, like the Australian Property Investor magazine. And all of a sudden I had about 100 people ask, can you find us unit blocks or, positively geared properties? It's always about positively geared. And there was no real big buyer's agent industry back then. And then, it was an accidental business. I just started, basically doing a little cashier job, saying, all right, I'll help you, cut
take
the
a fee on it. And
and I'll just go find it and do all the negotiating for you. So
what year was this?
This is 2015. So pretty much when we were buying the commercial properties, but it was residential focused. So I never started talking about commercial and probably till 2017 in the business, because I learned by doing, and just, wanted to get some runs on the board, see how it really worked, rather than just go, straight into this. Because back then the residential still made sense, and it still does today. But at a certain price point, it doesn't.
Yeah, that's interesting, because a lot of people don't take that view on things and go, I've got an opportunity here. I'll fake it till I make it.
Yeah.
Right. And, when you're giving investment advice to people, faking it till you make it is a bloody bad idea.
Yeah. And Australia, so when I started, there's probably 20 odd buyers agents, and they were mostly geared towards purchasing owner occupiers. And now there's about 4,000, I think, probably, I don't know. They're on every corner. And like you said, most of them are very limited in experience.
Yeah.
Most of my clients have vastly more experience than the average buyer's agent in Australia. And you're right, you just got to learn by doing, and you won't understand how to manage a portfolio until you manage one. Otherwise it's all theory, and you're just reading and faking it, like you said.
Yeah. The name Rethink.
Yeah.
I can take a guess at why, but tell us about the name.
There's two parts. It's it's rethink. So it's almost like double think about what you're doing. And also it's challenging the status quo. So even my parents were part of the negatively geared warrior crew back in the, 80s, 90s, early 2000s. Because back then it was all about buy a property, negative cash flow, and get a bit of tax deduction back. My father was an accountant, for example. So he did quite well out of that strategy. But back then prices were 5 to 10 times the average income. Now they're 15 to 20 Like you can't be negatively gearing that much, it'll send you broke. And that the idea was like, don't do what previous generations did. Like, because the rules change. Like the rules have changed in my era. Like I started residential, and then I thought I was going to go forever in the residential space, like own 100 places, like, you know, but you're mad to do that strategy now. And it might change again. Like commercial's great right now. The market might explode over the next 5 years and the value might not be there. And then at that point, I don't know, there might be another asset class. But you don't just blindly follow something forever. You got to move with the markets.
Yeah, surely some commercial property in the metaverse, that must be up for grabs at some point, right?
I'm glad I didn't get into that.
Yeah. Remember the guys
I remember.
telling us about the bunnies with the gold jackets.
You got to get the bunny with the gold jacket, man. I'm like, what are you talking about?
Yeah. Okay, so I love that story in terms of like doing some cashy jobs, just one thing after another.
Yeah.
The initial, obviously, you're right. We talk to Australian clients, and buyers agents are very big. They're not big here at all. No. Initially, when you were, talking to clients about, fee for service and probably the pushback from the agent, how were those early days?
Very difficult. So when I first started, I had this deals of the week printout, and I emailed it to like hundreds of mortgage brokers, because that was my idea of getting a lead source, because they're kind of on the coal face dealing with the pre-approvals. And I'd have like 5 really good deals there, and I'd send it to them, and I'd have lots of meetings out of it, probably like 3 or 4 a week. They'd catch up, and as soon as I mentioned a fee, I was just an individual, they'd laugh at you, and like, I'm not going to pay you, 1 or 2% for this. Like, I'll just call the agent. I go, well, it's I found it. This one's off market. You can't get it. It was really difficult, to be honest. Now everyone knows what the buyer's agent industry is. It's like a sales agent. No one scoffs at paying. A lot of people do paying a sales agent, but
you do it.
But you get it.
It's the cost of doing business.
Exactly. Yeah. But like nowadays, no one questions it, and it's a bigger business, and rightly so. Like there's a lot of costs involved. Like we've got 3 divisions, main ones. You've got the due diligence team. That's my favorite part of the business, because they're literally they're there to check every little aspect of the property. So when I buy one, I just send it to them, and they call up the council. They check the numbers. They get quotes for insurance. They check legalities. Get if we need things like environmental reports, it all gets organized, packaged up. It's like a 50-page report, sometimes more, sometimes less. The acquisition people, extremely valuable, because they're locals. Like we've got, 2 in New Zealand already, and they're basically talking to agents, talking to fund managers, like getting access to these deals off market, and then negotiating as hard as they possibly can. So when we present a property, it's not asking price, it's negotiated price. So sometimes it might be 10, 20% off, well, not 20%, 10 to 5% off the price. We're charging 1.9%. So, you're covering your basis just through the negotiation alone. And then we've got like our advocates or salespeople, relationship managers, whatever you need to call them. And they're there to hold the hand of the client, understand their brief, manage the complex process of purchasing a property. Because it is, you've got generally a 28-day finance and due diligence period. In that time, you've got to get all the DD done. You've got to liaise with your mortgage brokers, your local legal team, get property managers, get quotes for insurance. Like if this is your first time, you're not going to get it done. You're going to miss things. So they're the glue that keeps it all together.
Yeah, cool. And then so we've got a pretty substantial team now at Rethink. What's next? You're coming into New Zealand, having a look at this market. Where do you envision Rethink as in say 5 years?
Look, we're pretty happy where we are. We just want to, like, we got a very high market share. It's probably it's around 60%.
Yeah.
So it's a small industry. So that 60% is, like we do about 50, 55 purchases per month. The residential side, like we do residential, much smaller, a lot more competition, but it's a massively larger market. In Australia, the residential market's worth about 11 trillion. Commercial's about 1.5 trillion. So it gives you an idea.
Yeah.
And a lot of that 1.5 trillion is 100 million plus deals too. So we're in that 20 mil, sub 20 mil space. But yeah, to answer your question, what's next? We'll probably introduce a couple more verticals, like because we've got all sorts of businesses like
could we talk us through those?
So it started with Rethink Investing. So that's the buyer's agency. We've split that into Rethink Residential and Rethink Investing remains the commercial side. So 2 businesses now. Got the Rethink Financing, which is commercial financing in Australia. We've got the Rethink Renewable business. That's probably the only one we'd bring to New Zealand, I'd say, because we want to work with New Zealanders. Because it's like we're Australians. We've got like my team will be all New Zealand. Because you need to use the locals to get the best approach. But the renewable energy business is essentially solar panels, battery storage, and EV charging. The benefit of combining all 3 of those things is you create more yield on the property. It's basically an income, and that income creates equity. So it's a value add strategy via equity and cash flow for the owner. Our angle is I purchase the solar panels, so it's not, and then we lease the roof out, we lease the battery storage. So it creates a third party lease, and that's how it creates equity. It's a very different angle to what others have done. There's 2 options as an owner. You either do it, but a battery could cost $500,000 cash. The solar panels might be 200. If you've got 700 grand cash, you're probably better off just buying another commercial.
Yeah.
That's what most people want.
Yeah.
But we're solving this problem. Go, all right, well, we'll come in, create the income, and it's basically like a win-win situation. The tenant also wins too because they get cheaper power.
Yeah,
Generally
fascinating.
20%.
Yeah, it's not like a very like if you're talking about the integrations, it's not one that I would think of off the top of my head to be like,
man, it's not sunny enough here. That's why it's bloody rains all the time.
Yeah, I know, but it definitely, there's more margin in Australia for those. And look, but it works in Tasmania, similar latitude. So there's
works in Tassie to work in Auckland. All right, I want to talk. How big's the team you've got in Australia?
It's just over 100.
Okay,
yeah.
Cool. So being a property investor and being a CEO leader, very different things. How have you found that transition from doing cashies on the side? I'm sure you've run into a lot of challenges on the way to building this brand that is a win-win where you've got a great business, you're helping your clients make lots of money. What's been the journey for you like as a founder and CEO?
It's been interesting. I definitely say first and I'm always an investor first. That's how I built the business with investing in mind. I've enjoyed the business a lot more in recent years. The early years, I'm not a sales. I really hate sales. To the point where if I get a cold lead and they don't already know us and they're talking to me, I really don't want to have to sell myself. It's almost like, can't be bothered type of thing. But I've got sales guys that love that. It's a challenge, and turning them gets them a high. But I just like investing and then helping others do the same thing. So nowadays, it's not about making money. The business side's kind of about building the business, helping more people. So it's, you guys would know it. You've got a great brand yourself. It's kind of building the awareness of that. That's the most important thing now. And I think the industry is a little bit it's going the other way because of all these new starters too. There's some great operators, but the majority of them are just, like you said, I don't want to speak bad about competition, but they're just not technically up to, and then they're investing people's life savings. And I've seen so many horror stories over the years, and I've seen so many portfolios built by others that are just junk, and they've got to sell them off. And the advice is really important, and you've got to get the right advice. So if we can influence that, and that's why we're very big on education. We do these things without the idea of trying to sell back. But if someone just questions and learns a little bit more themselves, and that has a greater good.
It's really interesting to see. It's quite stark, the contrast and advice that you can see in people's portfolios, where someone is given advice to make money and someone is given advice because it is the right advice and you're trying to do the right thing by the customer. Very easy to see that in someone's portfolio.
Yeah, I saw a portfolio the other day. It was made up of mostly Gold Coast units, and the strata on each one of them was enormous. And then the strata gets bigger each year as the building gets older. Yeah. And they were negatively geared to the sum of 150 grand, and they, doctor, had good income, but they're working now to keep the portfolio. Yeah. And it's to sell that, and most of them hadn't grown in 5+ years, and because as the strata goes up, it does affect the value. And you can't fix some of these things. You have to sell at a loss, and then they don't want to. So you're kind of then stuck.
Start throwing good money after that.
Yeah, there's
It's
a lot
like
of
when a
those.
share price has dropped and somebody's like, "Oh, I'll sell once I get back to a certain point," and you're like, "Oh,
Yeah.
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 yeah,
There's
awesome."
an opportunity cost.
Yeah, I mean, this has been really good, Scott, to hear your story, to kind of learn, what you've built through investing into a business. For those that are interested in finding out more about commercial property, or maybe talking to one of the team about, whether buying a commercial property is right for them, how do they get in touch?
Just Google Rethink Group or Rethink Investing. So they're the sort of two main companies, and just reach out, and happy to have a chat about your portfolio. And yeah, look, it's all about just individuals' experience. So there's no cookie cutter approach, but yeah, having a chat's the starting point.
Cool. Awesome. And then on the education side, if you go, I want to find out more about commercial property, we're going to be doing 2 more episodes with Scott. We're going to be talking about resi versus commercial and commercial property in Australia versus New Zealand. The only way you're going to see them is if you subscribe to the channel, give us a review, give us a like, and we'll catch you next time.
Thanks to Partners Life. Cheers.